Welcome everyone. On behalf of Marie Brière and Sophia Ramos, it's once again a pleasure to welcome you to this webinar organized by the ESSEC Amundi Chair. I would also like to thank Celia Lecha, who recently joined us with the chair. She's replacing Vanessa Thomas, who's been with us for many years now, and Vanessa has moved on to other responsibilities, so she's been replaced by Celia, and we thank her very much. Finally, I would like to wish everyone a happy new year for 2025 and all the best to you and your family. So today's webinar focuses on the use of AI and machine learning in asset management. Over the last decade, the use of AI and machine learning in financial industry, in particular in asset management, has developed at a significant pace. These tools not only improve access to information, but also the way it is processed and analyzed. The new opportunities introduced by AI and machine learning raise new questions and challenges for asset managers. For instance, how does the increased accessibility to information impact on the role of asset managers? Does this information allow them to allocate capital more effectively to generate positive risk-adjusted returns? In addition, in recent years, some self-declared AI funds have been using these tools to apply AI-enhanced strategies. This raises the question of whether these funds outperform their benchmark and provide investors with any advantage. The two papers in today's program provide a light on these two questions. In the first paper, presented by Romeo Tedongap from the ESSEC Business School, the authors use machine learning models and classic econometric tools to predict the mutual fund managers' convictions about stock value. This allows them to design what they describe as a SaaS Oracle strategy that consistently outperforms market index. This suggests that investors can enhance their portfolios by learning from mutual fund managers' historical holdings, which reflects skilled decision making. The second paper, presented by Mauricio Praxmarer from the University of Innsbruck, examines the performance of AI funds. They first look at whether funds relying on AI and strategies outperform their benchmark. Then they investigate whether the observed returns are due to skill or luck and analyze the stock selection and timing abilities of AI funds. As usual, participants are encouraged to ask questions on the chat. They will be answered at the end of each presentation. I wish you a very good webinar. And now I'm turning on to Marie Brière, Head of Investor Intelligence and Academic Partnerships at the Amundi Investment Institute. Marie?
Thanks a lot, Jocelyn. So very happy to be here with you today and a happy new year to everyone. So it's my great pleasure to co-welcome you today together with Jocelyn and Sophia to this new Amundi ESSEC webinar on the use of AI and machine learning in asset management. So as you all know, there is a growing use of AI in investment. And that raises, as Jocelyn said, a number of questions on its added value and its impact. AI can be used at different stages of the investment process. It can be used to screen information and design signals, in particular non-quantitative signals, such as text and images. And this was the topic of our previous seminar. It can also be used to combine signals in an efficient way, in particular through machine learning techniques, and to optimize portfolio. And last but not least, it can be used to design optimal trading execution. So today we are not going to cover every topic, but just tackle two very important questions. First, what is the value of AI for investment? But also maybe an under-researched question, which is, does AI funds attract clients? And very important for Amundi and the investment management industry. Of course, there are many more questions that probably we'll try to tackle in the next seminars. In particular, the question of the riskiness and the correlation of AI strategies, the consequence of their adoption on market efficiency, stability. Jocelyn mentioned also the efficient allocation of capital. But also a very important question, which is under research probably, which is how should humans and machines interact efficiently in an investment process, which is a key question for some of our colleagues, in particular portfolio managers, which are keen to adopt these kind of tools. So I'm really happy to welcome two prominent speakers, Romeo Tedongap and Mauricio Praxmarer. So I would like to thank both of you for your participation, but of course also Sophia, Jocelyn and Celia for the great partnership that we have between ESSEC and the Amundi Investment Institute. So with that, I think, Romeo, the floor is yours.
Well, thank you, Marie. Thank you, Jocelyn, and Sophia and Celia for inviting me and organizing this webinar. Thanks a lot for this opportunity to present for the first time in the webinar, and welcome to everyone. I also follow on Marie and Jocelyn wishes to wish you as well as your families a good 2025 year. So the paper I'm presenting today on learning from the wisdom of mutual fund manager, it's a joint work with Jules Tinang, who at the time we were writing this paper, we started to write this paper, was at the University of Groningen, but now he's back to the Paris area, and he's on the job market. So I'll tell you a little bit about the genesis of this paper. I was reading a bestseller by John Maxwell on how successful people they think. And something interesting that I read in that book is, not only we can learn how successful people they think, but we can also mimic them. We can also mimic their way of thinking and be as successful, or at least try to be as successful as they are. There's been a long-standing question in asset management, the asset management industry and research, asking whether mutual fund managers are successful. Are they skilled? Do they have the capacity to use their information to select stocks that are going to be the best performing one and actually outperform the index that they're following? And when I say the index that they're following, they're not always following the same index. The index that they're following can be specific to the fund that they are managing. But overall, are they always able to beat that index through, picking stocks in a skilled way, in a skilled manner? So this is one question. And the second question is, if they have those skills, can any investor in this age where there are technological advancements such as artificial intelligence and machine learning techniques that Marie mentioned earlier, can any investor who try to learn from the way that these mutual fund managers they invest, can we learn from their holding, their portfolios, their past portfolios, and try to follow their strategy in the coming period and be as successful as they as them? So this is the two questions that we try to address in this article. Are mutual funds skilled? Collectively, if they are skilled, can we learn from those skills and invest profitably? And we address this question in the paper. We follow the literature, of course, on the skills of mutual fund managers, what have been told, all the disagreement that are in the literature regarding these skills. And of course, we also use machine learning techniques to learn from their past holdings, which they can disclose following a SEC rule. And based on that, we construct portfolio strategies by trying to forecast how they're going to, what they're going to disclose in the next period about their past holding, given that at the time when they disclose, they disclose this information about their holding with a lag. Okay, it is not a contemporaneous disclosure. So, and that's the reason why we can use some characteristics of the stocks to try and machine learning techniques to forecast what they're going to disclose later about their past holding. And based on this forecast, we will build a strategy as if, so basically our strategies is based on the prediction of their forecast, given that they are disclosed, the prediction of their holding, sorry, given that they are disclosed with lag, okay? So essentially, this is what we do in this article. So let me give you very quickly the outline. So basically, I already shared the motivation behind this work. I will walk you a little bit through the literature and how we position ourselves, okay, with respect to it. I'll give you a very, small view of our preliminary finding, but I will really limit myself to the capacity of the machine learning to predict this, mutual fund view about the stock. And I will also discuss our data, this measure that we introduced for the mutual fund conviction about the stock value. Then I will walk you through our empirical result before concluding with, of course, what we couldn't do and why we couldn't do it. Okay, let me start by, again, going back to the motivation by giving some example of article that actually question the ability of mutual fund manager to beat benchmark indexes. And some papers, they say, well, mutual fund, they perform, but, maybe they do not when you account for the fees, right? And there are papers like Carhart and Fermat and French who actually address this question. So, well, even if they are skilled, the return after fees is not always, profitable. And now, other papers, of course, they provide evidence of mutual fund manager skills. Okay, that they can actually pick up stocks so that they overall they generate positive risk-adjusted returns. Now, now that since 2004, the SEC has mandated for public disclosure, and that mutual fund now they are allowed to disclose their holding on a quarterly basis, but they can also disclose that with a delay of up to 60 days. Okay, so basically, we can maybe by observing this disclosure of mutual fund holding, try to learn about how they invest and try to see if we can predict this way of investing and also invest ourselves as simple investors according to this information. Okay. Now, in terms of and for this, of course, we're going to use machine learning tools, machine learning models, like very standard one, to try to predict how mutual fund to try to predict a measure of active management, okay, of the mutual fund, and that measure will be stock specific. Okay, I will introduce it later. So our motivation is therefore to train this machine learning model from the history of mutual fund holding, and then develop an investment strategy based on our model's predictions. Okay. So, of course, the paper aligned with several others in the literature, especially Kapelschicht and Kremers and Petagisto. They predict mutual fund performance through stock weight deviation from the benchmark. So basically, what they do is that they consider all the stocks that are held by the mutual fund, and then they compute the deviation from benchmark as the weight of the stock within the fund, the difference between that weight and the weight of the stock in the benchmark. Okay, that's the fund-specific benchmark, not necessarily a stock index as we're going to consider in this article. So, and once they compute this deviation from the benchmark for every stock held by the mutual fund, now they average across stocks held by the mutual fund. So basically, this is a fund level measure. And they use that fund level measure to predict the performance of the fund. So basically, are the funds that are deviating the most from the benchmark, do they perform? I mean, can this deviation predict a larger performance, okay, for the fund. So this is basically what they do. So to the contrary, our measure for deviation, for the deviation of from the benchmark, it's not at the fund level. It is at the stock level. So basically, we consider for a given benchmark, which is common standard, we are going to consider all the constituents of our index, say the Standard & Poor's 500, and we're going to look at the holding of all mutual funds in that stock. We're going to compute the difference between this holding and the weight in the stock index, and we're going to average across mutual funds at this time. So it's going to be a stock level measure. And this stock, of course, actually summarizes the mutual fund conviction about the stock value. So it's a stock level measure. And what we're going to do is, we're going to use that stock level measure to form portfolios. So basically, we're going to sort stocks based on these measures, so we can classify them into those that are deviating the most from their benchmark matching weight, and those that are deviating the less from that. And we will study the performance of portfolios from or based on that basis. Okay. But also other articles, Anton and co-authors, they develop best ideas portfolios for mutual fund managers by maximizing, for example, the Sharpe ratio of individual managers' top ideas. But our strategy actually seeks to identify the best ideas across all managers, okay? So our portfolio is going to be more concentrated compared to what they can obtain, okay? So because by sorting stocks and let's say focusing on the top quantile based on this stock level measure that we're going to introduce later, of course, we are focusing only on a few stocks, okay? Which is could be the top decile if you are forming decile portfolios, or the top quintile, or the top tercile if you're forming tercile portfolio. But in any case, our portfolio is more concentrated. Okay. And also many other papers, they use machine learning and with multiple predictors to create portfolio that outperform the market. Again, to the contrary of this paper, we focus only on the constituents of a common benchmark index like the Standard & Poor's. Okay, and we exploit fund holdings to build our dependent variable, which is this stock level measure of the manager's conviction about the stock value. Okay, now we are focusing on the performance of stocks that deviate from the benchmark. But other recent papers like Kenyel and co-author, or De Miguel and co-author, they focus on the performance of mutual funds, not of individual stocks, okay? But the performance of mutual funds. So they're trying to select the best performing mutual fund based on a measure, based on a deviation from a benchmark, while here we are focusing on selecting the best performing stocks, okay, based on a deviation that is similar. But again, as I explained, their measure is a fund level measure that is averaging the deviation across stocks within the fund, while ours is a stock level measure that is averaging the deviation across the mutual fund that actually reported holdings on this specific stock. Okay, so that's in terms of the literature. So what are our findings? So we find that I mean, based on our result, we can infer that managers they collectively possess the skill that they reveal through their holding, and these skills serve as a valuable information source for creating profitable asset allocation strategies. So that we can confirm. So basically, what we're going to do, we're going to assume, for example, that we can anticipate the manager's disclosure, the manager's holdings. So what they disclose, we assume that we can anticipate that. So basically, again, as I said earlier, they disclose this with delay, but if we assume that it was contemporaneous, meaning that, we guess exactly what they were, that they will disclose later, and we form portfolio based on this, exact guess. So like an oracle, and we call it the SAS Oracle portfolio strategy in our case. So we see that, of course, we always beat the index, whether it's a small cap or a medium cap or a big cap. Now, but of course, this Oracle strategy is not feasible because of the delay in the disclosure. So that's why we bring machine learning models in the game and say, well, since this information is going to be disclosed only later, now let us use stock characteristics that we observe today and try and use a machine learning model to predict a measure that is based on this information that will be disclosed later. Okay, and then once we predict that, then we can form portfolios. So this is what is feasible. So the SAS feasible strategy here is the one based on the prediction, okay, and not on the information that is not already available at the time we want to form the portfolio. So as a recommendation for investors, our machine learning based approach yields better returns also compared to average analyst recommendation, because of course we also compare our portfolio strategy to analyst recommendations, to the portfolio that we would have invested in by following analyst recommendations. Okay, and we see that we constantly do better than analyst recommendations. Analyst recommendations themselves, they constantly do better than the index. An exercise that we do last is to try to understand the relation between this stock picking strategy with a strategy that also picks stock based on sustainability measures. Okay, and we find, for example, that this stock picking measure, which we call a stock active share, so that's the SAS, we see that it is negatively correlated with carbon intensity, meaning that the SAS strategy is compatible with ESG investing because it picks stocks that also help achieve sustainable investment objectives. So in a sense, we can ally both financial performance and sustainable investment objective. I confess that this part of the paper is still light. We started to do this analysis only recently, but I believe results are promising. Okay. So in terms of finding, we are going to follow 3 different indexes. So we're going to consider the Big Cap Standard & Poor 500 as the benchmark index. So look at the mutual fund disclosures of their holdings in the constituent of this Big Cap index. So we're going to construct our measure and predict the measure using 4 different machine learning models: deep neural network, random forest, gradient boosting, elastic net, and OLS also. And then we're going to use this model and the disclosure and the stock characteristic to forecast our stock picking measure, which is the stock active share. And then we're going to, in this graph, I'm showing the correlation between our predictor and the true SAS value that is used in the Oracle portfolio. And we see that the machine learning model, they predict pretty well, because the correlation between the true SAS value that will be disclosed later based on information on holdings that will be disclosed later by the mutual fund is substantially correlated with the prediction from the machine learning model. In a sense, it means that if we form portfolios based on the prediction, this portfolio will resemble the one that we form based on the true measure. Okay, and the correlation in this case lies between 60% or more. Okay. And what is also important is that an aggregate measure based on analyst recommendation is just neatly correlated with the analyst with the SAS measure. Okay, so basically, analyst recommendation and our stock picking measure they do not show a strong correlation, so they capture different information. Okay, which is also important to compare the portfolio forms on both measures. So we see this same level of correlation, but maybe less when we consider Standard & Poor's 400. These are small cap stock, and Standard & Poor's 600. These are mid cap stocks. Okay. So this is, a snapshot of the result regarding the performance of the machine learning model to use stock characteristics to predict a stock picking measure based on information that is disclosed by the mutual fund. Okay. So now, what data do we use in this paper? We use survivor bias-free US mutual fund database. Our samples span 2007 to 2023. And again, the SEC rule requires that mutual fund they disclose their quarterly holding within the next 60 days. Okay, so there can be a delay. We also select funds that invest in common stocks. Mainly, so basically 2/3 of the asset are in common stocks, at least 2/3, and we exclude index funds, so funds that are based on indexes such as Standard & Poor's and so on. Additional data that we gather from Aecon data stream is the benchmark index, the list of their constituents, and also their portfolio weight in the index. And we also collect data on Fama French factors, so the momentum factors. This will be important for computing, for example, the alpha that is generated by our portfolio strategies. Okay. Good. So this said, just some word about the data, some statistics on the data. So in this in the left graph, I show the coverage. So basically, this is the percentage of the Standard & Poor's 500 capitalization of the stock that are held by mutual funds in our sample. Okay, this shows the evolution. So, for example, in 2022, 80% of the large cap stocks that are which information is disclosed by holding information is disclosed by the mutual fund. They represent more than 80% of the Standard & Poor's index. So the coverage is pretty important. We have a similar coverage if we consider mid cap and large cap indexes. And in the right panel, I show the number of mutual funds that disclose information about their holding on Standard & Poor's, on the constituent of the Standard & Poor's 500 index. Okay, recently, I mean, we have on average more than around 1,200 mutual funds in the recent years. Okay. Now, so what is this stock picking measure that I was introducing earlier? We call it the stock active share. So basically, it is the cumulative, and this is cumulative across mutual fund. So let's say in month T, for the stock I, we compute the deviation for every mutual fund that has held that stock. We compute the deviation between the weight in the mutual fund and the weight in the index, in the benchmark index. And again, all these stocks, they belong to the benchmark index. So the Standard & Poor's 500, so we're going to compute this SAS for the 500 stocks in the index, okay? So we compute this deviation for every stock, and then we take the sum across mutual fund. Well, there is a reason why we don't take the average. I can say it immediately is that if you take the average, then you will not be able to make the distinction between one fund holding deviating from a stock and being the only one in the market, and several funds deviating, having the same deviation on the same stock in the market. Okay, so by taking the sum, we also account for the market consensus on this deviation. So and that's the main reason why we consider the sum and not the average. But we also compute the net stock active share, which is simply the same sum of the simple deviations, not the absolute deviations. Okay, and again, this is the main quantity that we're going to use in the subsequent analysis. We're going to forecast this using the stock characteristics, given that at the time we want to form our portfolio, this SAS measure is not available since the W will be disclosed later with delay by the mutual fund. That's the reason why we consider machine learning model in this analysis. Okay. So first of all, some summary statistic about this deviation from the benchmark. So the deviation from the benchmark is simply the difference of the Ws, not cumulated yet. Okay. So this deviation from the benchmark, it gave us an idea. So in this table, we have 4 panels. The first panel gives us the weight of the stock in the mutual fund portfolio. In panel B, we have the weight of the stock in the benchmark portfolio. In panel C, we have the deviation from the benchmark, and in panel D, we have the absolute deviation from the benchmark. So what we see here is that on average, if I look at panel A, on average, mutual fund, they have 0.85%, okay, of their wealth invested in a typical stock. So this is average across time and across mutual fund. Okay. Now, if they invest exactly as in the index, they would put 0.31%. So this tells us that mutual funds, they have the tendency to overweight stocks relative to the benchmark. And if I look at this average for the subsample where deviations from the benchmark is positive, we have more than 1% that they invest in these stocks in the mutual fund compared to 0.27% as in the benchmark index. Okay, so and if you consider the same average for stock where the deviation from the benchmark is negative, so basically they invest on average 0.24% in these stocks, while if they invest exactly as in the benchmark, it will be 0.43%. Okay. So what is also important to see here is that the deviation from the benchmark and the absolute deviation from the benchmark, they are highly correlated, close to 90%, close to 0.9, meaning that, most of the time, these deviations, they are positive. And that, whether we use our SAS measure or the NSAS measure, we will likely pick similar stocks. Now, if I look at the NSAS and the SAS measure, so that's the net stock active share and the stock active share based on absolute deviations. What we also see here, if I focus on panel A, that shows the weight of stock holding in mutual fund portfolios. This table shows the same as before, but now I'm cumulating the deviations across the mutual fund that are reporting holding on the different stocks. Okay, and what we see here is that the NSAS measure, the net active share, most of the time is positive, because out of 97,000 stock month observation, we have more than 96,000 that are NSAS positive. Okay, so most of the time, this also confirms that this tendency for the mutual fund to deviate from the stock by outweighting them relative to the benchmark index. Okay, and again, the correlation between the NSAS and the SAS is close to 80%. So again, both they almost speak the same language. Now, so with this, the portfolio strategy, in the interest of time, the portfolio strategy will form stock based on the SAS measure. So if I form stock based on the SAS measure, as if the SAS was observed contemporaneously, I call this strategy the SAS Oracle strategy, okay? And let me show the result of forming portfolio based on the SAS measure of Indicide portfolios. What we see here in the top panel is that, first of all, these portfolios, in the last column of the table, we have the benchmark index, and the rest of the table, we see the quantile portfolios formed based on the SAS. And what we see is that these quantile portfolios, they outperform the benchmark. And the Q1 is comparable to the benchmark, but of course, this is understandable because the Q1 portfolio has the smallest deviation from the benchmark. So you're almost investing as in the benchmark, right? So, but for the remaining one, we see that when the deviation from the benchmark is significant enough, then we outperform the benchmark, okay? And this holds both for the big cap, the small cap, or the middle cap index, okay? And what is also important to see here is that these portfolios, they have, they tend to be, I mean, the top quantile portfolio every time has a smaller standard deviation compared to the benchmark. So not only we are doing well in terms of return, but we are also doing well in terms of risk. And in terms of alpha, well, the benchmark alpha is close to 0, while these portfolios, they show significant alpha. But again, this strategy is not feasible. And to be able to have a feasible strategy, we need to predict the measure and reform the portfolio based on the prediction, and instead of the set itself. So what we do is first to show that the machine learning model that we consider here, they have a strong predicting power with respect to the SAS. And we see it here. If I only focus on the deep neural network, again, in the interest of time, we see that I report here 2 R-square. There is 1 R-square that does not account for the bias in the estimation, and another R-square that account for the bias. So if the 2 R-square are equal, we may interpret in saying that there is no bias in the estimation. And we see that, there is some bias when we consider the deep neural network. Okay, last panel, last column, there is some bias on the Standard & Poor's 500. But while for mid cap and small cap, there is no bias. Keep this in mind because it's also important to interpret our result cautiously when there is a bias in the estimation. Okay, so but overall, what we see from this table is that the machine learning model, they are able to predict the SAS measure with a good, predictive. They have a good predictive ability in this exercise. Okay. So overall, this is what we see. Now, let me go to the SAS feasible strategy, and I will show the result only for the top portfolio. This is the portfolio, the quantile with the largest deviation from the benchmark. The top 10, if I do DeSci portfolio, top 5 for quintile portfolio, and top 3 for TerSci portfolio. These portfolios are rebalanced quarterly based on the SAS measure, and I will still report the same usual performance metrics as before. Okay, so now in this table, I'm simply showing the top portfolio with the most largest deviation. Again, the last column shows the benchmark index, and I show the portfolio that are formed based on the prediction of each of the machine learning model that I consider in the paper: random forest, gradient boosting, OLS, elastic net, deep neural network, and I include the prediction. I include the performance of the portfolio formed on analyst recommendations, and finally, the performance of the Oracle portfolio that is formed on the SAS itself, assuming that it is perfectly anticipated. Okay, so what we see again is that all these portfolios, they beat the benchmark index. If I look at the Standard and Poor 500 portfolios, the mean is between, it's around 1.4, while for the benchmark it's 1.1. And the volatility again tend to be smaller compared to the benchmark for some of these machine learning models. In terms of alpha, of course, the alpha is always higher and significantly estimated compared to the benchmark where the alpha is 0. So again, based on the prediction is doing just as the Oracle, okay, in terms of portfolio performance. So basically, we are able to use machine learning model to predict this stock picking measure that is not observed, and that is based on managers' holdings. Okay, and this result is also true for other benchmark indices. Now, I will finish the presentation by discussing the relation with sustainability. So for every stock, we compute a carbon intensity measure of the company as the total CO2 emissions divided by market capitalization, and then we run a very simple regression that relates the stock active share to the carbon intensity, and we find a negative relation that is a negative relation that is significant. For small cap, for example, we find that a 10% increase in carbon intensity will reduce the SAS measure, and for mid cap stocks, this is where it is more. It is larger, a 2.9 with a 2.9% increase in the SAS for a 10% increase in carbon intensity. We also have a reduction for big cap stocks. So what we conclude here is that stock with lower carbon intensity, they are more likely to be favored by fund managers, suggesting that there is a concern for responsible investing, and that this is also compatible with financial performance. So even this result is not, we are still working on that, but it is again a promising result, and implying that SAS strategy can align with sustainability concerns. Okay. So just to conclude, we prove that mutual fund managers, they collectively possess stock picking skill, and that these skills, they can lead to stock outperformance. So we apply machine learning techniques to mutual fund holding, and we construct portfolio based on stocks with the greatest deviation from the benchmark. This deviation from the benchmark measuring the mutual fund managers' collective view about the stock value, their conviction about the stock value. The machine learning strategy outperformed the traditional analyst recommendation and offer a more effective investment approach. So something that we do not address, and many papers that actually do cross-sectional asset pricing like this one rarely look at the transaction cost, how they will affect all these results. And this is, again, something that we are working on with the intention of situating the performance of our investment strategy within the distribution of the mutual fund returns. Okay, given that these returns they are net of fees and transaction costs. Okay, so thank you for your attention, and looking forward for your questions, if any. Thank you.
Thank you very much, Romeo. Thank you very much. Maybe a few questions from the audience. Have anyone questions? Marie, you want to ask a question?
I can start asking one. So thanks a lot, Romeo. Very interesting paper. And I would find very interesting that you compare your new strategy to another kind of machine learning portfolio that would be based on stock characteristics. And the reason for that is that in a way, what you're doing, what your implicit hypothesis in what you're doing is that fund managers have information that cannot be accessed, by us, by researchers, using information that is traditionally available, right? So there is something additional that you're trying to forecast in a way, but kind of information that they are using, which allows them to make the good stock picking selection.
Exactly.
So I would like to benchmark them to, this Brian Kelly's paper where they are comparing a lot of machine learning. Yes. So I would like to benchmark your method with this kind of techniques, which are aggregating a lot of stock characteristics, hundreds of stock characteristics with machine learning techniques. And I would find very interesting to see what the value added of humans versus machines in a way. That's what you would be measuring. That's the way I would frame your paper. Very interesting.
Yeah, thank you. Yes,
So yeah, I also have a question related to Marie's comment, because it's very paradoxical. It seems more efficient to predict the signal than predict the returns, right? Because it's more efficient. So
I agree, because other papers they use the same, I would say, similar information to predict directly the return. And we did receive the question from some researcher asking, why don't you simply predict the return and form portfolio based on the return prediction? Well, if we do that, we won't be able to answer the question about the skill of the manager. And by trying to predict the way they form the portfolio, basically we are considering more than the return. We are trying to predict, other type of measures that could be concerned for manager, like value at risk, like maximum drawdown, and so on. So I think the stock picking measure actually embed all this information, not just the performance. So we won't be able to answer any question about the manager's skills if we only focus on predicting the return itself. Yeah.
Yeah, another comment that I have is that you are saying that these managers, they are overweighting these securities, but someone has to underweight the securities. So who is underweight?
Okay, that's a very good point. So what we find is that in the Standard & Poor's for large cap, they tend to overweight large cap because 74% of the large cap they had a positive deviation from the benchmark. Now, for medium and small cap, less than 50%, okay, they have a positive deviation. But for all indexes, in terms of magnitude, the magnitude of the positive deviation always is higher than that of the negative deviation, always. Yeah.
Thank you.
There's a question on the chat which says, is this proved to be correct? I suppose that the asset management industry will be more reluctant to disclose holdings. Once artificial intelligence will replicate these holdings, it will also leave less opportunity for market inefficiencies. So PM ability to outperform will go to null. What do you think about that?
So can you summarize, Jocelyn? I'm not.
The idea is that if you know the idea is that the asset manager may be reluctant to release information, to disclose information on their holdings, because you can construct strategies to basically outperform that.
Ah, okay.
Sorry,
Yeah, I see.
I can add. It's
sorry,
coming
yes,
from me, the
Fabio.
question. It's Fabio. Yes.
Yeah.
So the point is that if you have the ability of machine learning to replicate the best portfolios, and everybody will do that, at some point, all the share price, all the stocks that were undervalued will be immediately fairly valued. So the room for creating outperformance in the future won't be there anymore if everybody is doing the same thing and buying the same stocks.
That's a very that's a very good point, Fabio, because there is this paper by Moore and Jones, I think, showing that fund managers, they actually follow the academic literature. So once a new predictor of mutual fund performance is found by researchers, now they embed this information, and next time it does not predict anymore. Okay, I fully agree with you, but here they have no choice because it is mandatory for them with the SEC rule to disclose the information. Something that is also very important here is to say that this is collective information. So they're not all performing at the same time, but if we aggregate the information from all the fund managers, we can use it effectively. But if you only follow a single manager, I'm not sure you can do this. So that's why, in a sense, what we do here is very comparable to how artificial intelligence functions itself, right? It uses aggregate information, takes different sources, and try to extract the best of it. So this is the same approach. So it's collective information, it's not individual.
Okay. But if you build an artificial intelligence portfolio, and Jocelyn builds another one, and Sonia build another one, and I build another one, we all have the same information, the same holdings that we need to buy. We're all going to be ending in buying the same stocks, if you know what I mean, all of us. Yeah, so those stocks will move quicker to the fair value, and then the ability to outperform. So your raw material, your source of information, will be less and less in the next round.
No, absolutely. But also, I'm not quite sure that we will use the same predictors, right?
Yeah. Maybe. Okay. Thanks anyway.
Thank you, Fabio.
Thank you very much, Romeo. I guess for the sake of time, we'll have to move on. Thanks, Romeo. So the next paper is by Mauricio Praxmara on AI funds. Mauricio, the floor is yours.
Yeah. Can you see the screen? Let's see if I can enlarge that. Perfect. Yeah, thank you for inviting me to present my research today. My name is Mauricio Praxmara. I'm a PhD student at the University of Innsbruck. And together with my colleague, Ivan, we looked into the potential benefits of incorporating AI into portfolio management. Over the past decade, AI has made some major leaps forward and also, as already discussed, found its way into the fund management industry. Especially funds that were offering AI-enhanced strategies have gained popularity among investors in the past few years. Especially the Amplify AI-enhanced equity ETF, or short by its ticker IEAQ, has contributed to that hype because it was the first one to introduce those AI-enhanced strategies to a general public through a retail investor-friendly ETF structure. And it's in its inaugural month alone, it collected 70 million from investors. However, the question that arose for us in that regard was whether those self-proclaimed AI funds would even be would deliver on their promise to yield those superior returns to their investors. Because while there is an extensive literature showing that AI strategies lead to improved portfolio allocations, as well as the strategy of Romeo, for instance, it still remains questionable as to whether everyone can adopt these funds, which also goes a bit into the question that was already posed by Fabio, because I believe this prediction will not happen because it poses that everyone could adopt those AI strategies that Romeo created, and I believe there are still a lot of retail traders that would not be able to do it. And second, it would mean even if funds can adopt those strategies, it is still questionable as to how much of those reported paper performances can be transformed into real returns after accounting for costs like market impact, the cost of training the models, the cost of getting the data, the cost of maintaining the AI models. The neural networks are really expensive to run on high performance clusters and so on, therefore creating higher costs for the funds themselves. And even in that regard, Avramov and his colleagues investigated machine learning strategies and found that those machine learning strategies exhibit high turnover or trade in markets with high limits to arbitrage, meaning markets or assets with low liquidity or high volatility, which both cut down strong on the real returns of funds. And in a similar manner, Chen and Velikov find that three effects, namely the trading costs, post-publication decay, and the liquidity implications of improved trading technologies render most of the considered AI strategies unprofitable. Following this thread of thought, we were trying to investigate the actual profitability of AI funds. And if a fund would then not be able to outperform, it would mean that they are probably not able to adopt those AI strategies to their advantage. But unlike previous studies, which just simply understate or just proxy those costs, market impact, trading costs, and so on, we decided to take a more hands-on approach. We would screen all the available US mutual funds for some AI components in their portfolio creation process, and then benchmark them to suitable or similar benchmark funds, because we believe that this would give us a much more accurate picture of how profitable AI strategies really are. Nevertheless, this methodology, we do acknowledge that this methodology relies heavily on reportings from the funds themselves rather than from an independent institution. Therefore, there is an incentive also for funds to use this label AI to generate further investments, saying we are an AI fund, and then a lot of retail traders just simply buy it because they put the label AI onto it, for instance. But we also investigate into that, and we will come to that later. Yeah, but before I dive into these methodologies, I'd like to give you a short preview of what we find and how we contribute to the literature. We analyze the profitability of those AI funds and compare them to suitable benchmarks. And we find that on average, the AI funds do not outperform a set of conventional funds. They also do not outperform a subset of quantitative funds. And one could have simply obtained a similar performance by following a value-weighted market portfolio over the same period of time. We also further contribute to the literature by disentangling those AI fund returns based on the stage at which AI is applied. And we find that there are some applications for which AI is already adopted successfully, and there are other strategies where AI does lag behind. For instance, or especially applications used for stock screening or identifying undervalued or mispricings is a task that has been already adopted very well by funds, according to our findings, whereas we find that funds that use AI to improve the allocation did not manage to outperform similar funds that try to do similar, to reach similar objectives without the use of AI. As I already mentioned, there are, or machine learning strategies characterize themselves by trading excessively or buying very liquid stocks. And in line with this, we find similar behavior among AI funds that rely on AI for allocation purposes. On average, we also find that they have good market timing ability, but any ability or any gains from that market timing ability is later offset by inferior stock picking ability. And as already mentioned, there are studies that show for ESG funds that ESG funds experience relatively high inflows. And this inflow creates a price pressure upwards. And due to inelastic demand, these ESG funds experience higher flow-induced returns. And we suspected that this label AI could create the same effect or provoke the same effect for those AI funds. Nevertheless, we do not find any evidence for that for our AI funds. And in fact, our evidence suggests that past performance seems to be the main driver of inflows, which is also the main driver of inflows for normal funds. Okay. The main part of our analysis revolves on identifying those AI funds. So how do we get to our sample of AI funds? To do this, we take the viewpoint of an investor and limit ourselves to publicly available information. The SEC 497K filings are filings in which mutual funds and ETFs are required to give a description about their methodology and their investment objective. And we then screen those descriptions on their methodology and their investment objective for a set of AI-related keywords. And due to misleading matches, we validate each match manually. Just to give you an example for what such a misleading match could be, one fund claimed to use Lasso in the investment process. Nevertheless, upon closer inspection, we realized that Lasso does not stand for least absolute shrinkage and selection operator, but rather for long and short strategic opportunity, which has absolutely nothing to do with the regularized regression and machine learning Lasso. And obviously, we have to eliminate those false positives from our sample, and therefore we verify each match manually. And therefore, we also do not rely on ChatGPT AI itself to read through the text and verify the matches manually, because we still believe that there could occur some errors. Yeah. Also in an earlier version of the paper, we claimed that what we investigate are AI managed funds. But after various discussions at some conferences, we realized that we heavily rely on filings from the fund themselves, meaning that we are only able to observe those mutual funds or those ETFs that claim to use AI that really report it. If they say we use a mathematical model but do not distinguish whether it is an AI model or whether it is just a regression, we cannot distinguish it, and we have to drop them from the sample. Ultimately, we pinpointed 67 unique mutual funds and ETFs that use that actively claim to use AI, and the description would be better to say it's an AI level fund. Nevertheless, it does not render the whole analysis useless, because it opens a new area of research questions that you can deal. As, for instance, already explained when I talked about the contributions, that you can say, okay, maybe do these funds use AI in order to attract more attention from investors, for instance? And does it help them to get higher flow-induced returns, for instance? And which, to take away the result, it doesn't.
Mauricio, just a clarifying question. Is it funds using AI in their investment process, or could it also be funds investing in AI?
No,
you rule them out. Okay.
We do not focus on funds investing in AI or investing in NVIDIA and other technology firms.
Because you use these keywords, so there is a risk of misidentifying them. So you.
No, that's why we validate each fund manually, because there are also some matches where it says the fund manager has some master in machine learning or something, which of course also does not count as AI fund. We are really interested in funds that use AI from somewhere starting in market screening to coming up with the final weight of the portfolio. If they then use this to create a portfolio for momentum strategies or for value strategies, that's we don't mind at that point.
Thank you.
Exactly. So it is not entirely technology-driven funds or technology topic funds. Okay, once we have obtained these 67 funds, we have to benchmark them in some way. And we do this by following the methodology outlined by Hoberg and his colleagues. The idea is to find funds that have a similar fund objective and similar fund characteristics. The process there is as follows. We select a set of matching variables and standardize them across the cross-section to zero mean and unit standard deviation. And then we obtain the fund level metric by aggregating those individual set scores over the fund, over the portfolio level with the respective portfolio weights. And we then orthogonalize all the characteristics onto each other. And then we compare the characteristic vectors from the AI funds with the rival funds by computing the pairwise Euclidean distances. Funds that have a small Euclidean distance are then considered more similar funds, and funds with larger distances are considered less similar funds. And we then define a threshold, and all funds within that threshold are then considered the rival fund for that given AI fund, meaning that each AI fund is benchmarked against a portfolio of rival funds. What we also do is, apart from using this characteristic vector, we filter all funds that operate within the same Lipper investment objective, meaning that we compare AI value funds with non-AI value funds. We compare AI momentum funds with non-AI momentum funds. So to say that the underlying risk factors do not have an influence on the return of the fund itself, in order to measure really the marginal contribution of the AI funds. Okay, let's dive right into the results. Here we plot the cumulative monthly returns of the equally weighted portfolio of AI funds in the solid line, the aggregate of the rival funds in the dot dashed line, and in the dotted line we have the equally weighted market portfolio, and here the value weighted market portfolio. We always include equal weights in addition to value weights due to the simple sheer size of the pioneering IAQ fund, which in sometimes comprises up to 30% of the value weighted portfolio. We see that in line with the previous research, AI funds performed well in the first few years. However, towards the end of the observation periods, AI fund performance deteriorated. And in the value-weighted case, AI funds did not manage to outperform the value-weighted market portfolio. And this slight underperformance also becomes visible once we adjust those returns for risk. Here we plot the Sharpe ratios of the equally weighted aggregates and the value-weighted aggregates of the AI funds and the rival funds. And we see both in the equal weighted case and in the value-weighted case, AI funds produced on average a smaller Sharpe ratio than the rival funds. We also repeated this analysis using quantitative funds. Quantitative funds are funds that use some sort of mathematical model to come up with a security selection. So in a sense, both AI funds and quantitative funds use quantitative analysis to arrive at an allocation. Nevertheless, AI funds go a step further by using AI algorithms, and whereas quant funds do not use AI algorithms. I also made sure that there is no overlap between AI funds and quantitative funds. But again, in the value-weighted case, AI funds were not able to yield higher Sharpe ratios than quantitative funds or the market. We then were interested whether those differences in Sharpe ratios would actually be statistically significant from zero. That's why we follow Ledoit and Wolf to check to compute the non-standard errors, and we find no evidence that those Sharpe ratio difference would actually be significant, meaning that AI funds do not manage to significantly outperform any rivals or quantitative funds or the market, but they also do not significantly underperform them. To further compare the AI funds with the rival funds, we regressed the returns of the rival funds of the AI funds onto those of the rival funds. The idea was that if the constant would be significant, we would AI would have would carry a premium beyond the rival funds or beyond the non-AI funds. Nevertheless, both in the value-weighted case and in the equal-weighted case and in the value-weighted case, AI funds have the constant is not significant. We then proceeded to use or to run CAPM and Farmer-French 4 and 6 factor regressions, and both in the equal-weighted case and in the value-weighted case, the constant is not significant, meaning that that AI funds do not create any alpha beyond the classical risk factors, which goes a bit in line with all the other findings that we already presented. For further insights, we then separated AI funds based on the stage at which they use AI. The subset of screening comprises all AI funds that use AI at an early stage of the portfolio creation process. This category is largely dominated by NLPs, natural language processing algorithms. 32 of the 42 funds that are in this subgroup of screening use an NLP. Nevertheless, the use or the application of the NLP varies a lot. There are funds, for instance, that use NLPs to evaluate the exposure of a given constituent towards a certain topic. For instance, one fund uses NLPs to evaluate the exposure of all possible constituents to the topic of e-commerce in order to create a better industry classification or a better topic classification that would go beyond the classical SIG or GIG classification of IT, for instance. It goes a bit into the direction of this text-based Hoberg and Phillips industry classifications. Another application of NLPs in this group is funds that use those NLPs to analyze or quantify and later analyze alternative data that is not available through the classical accounting information, but rather in text or images and so on. Yeah. And the subgroup of optimization comprises all funds that use AI at a later stage of portfolio management, namely for allocation purposes or to put weights on some predefined set of universe. Here, this group is much more heterogeneous, and also because applications vary from using AI to select the right predictors, using AI to evaluate forecasts, using AI to forecast, and so on and so forth. And also the complexity of the AI models varies a lot in here. There are basic machine learning models in this group, and there are also funds that use very sophisticated Bayesian neural network models, for instance. But what they all have in common, even though they are quite diverse, is that they use AI for allocation purposes rather than for market screening purposes. When we plot the cumulative monthly returns of those funds in a solid line of the AI funds, the dot dash line represents the rival funds, and the dotted line represents the market portfolios. We see that the funds that used screening, that used AI for screening purposes, managed to outperform both the rivals and the equal weighted market portfolio, whereas the optimization funds did not even manage to outperform their rival funds. So in summary, we could say that funds have already adopted AI successfully for screening purposes. Nevertheless, AI has not been yet successfully adopted to put weights on a predefined set of universe. And apart from this return perspective, we were interested whether those returns were the result of pure luck or whether the funds actually had some skill involved in there. And in order to assess that, we adopted the idea of Pastor and his colleagues, namely that the return of a fund depends on the general level of skill that the fund itself has and how actively it uses its skill to generate returns, modeled by a function G. We adopt this function G of fund activeness and split subsequently the general level of skill into a systematic and an idiosyncratic component. But first, let's look at the activeness. We recompute the fund activeness for all rival funds and AI funds and regress them onto a dummy that is 1 if the fund is an AI fund and 0 if it's a rival fund. We see that on average, AI funds are less active than the rival funds, meaning that they trade less or they trade less or they trade more liquid assets, which seems surprising because if you remember what I said in the introduction, there are studies that find the exact opposite. However, upon closer examination, we see that this result was driven by the screening AI funds, whereas optimizing AI funds are much more active, meaning that they trade more and they trade assets with much lower liquidity, which is then again in line with the previous findings. Regarding the general level of skill, we split it into 2 components, a systematic component and an idiosyncratic component as proposed by Kasperczyk, and namely timing and picking. Timing measures how the holdings of a fund co-vary relatively to the market with the systematic component of returns. We compute this timing variable and regress it again onto our AI dummy and onto some extra controls. And throughout all significant results, we see that the coefficient is positive for the dummy, meaning that AI funds have a relatively higher timing ability compared to their rival funds. On average, the associated return with this market timing ability amounts to 44 basis points in return units. When we repeat this analysis for the idiosyncratic component for stock picking, we observe an opposite image. Picking measures how the holdings of a fund covary relatively to the idiosyncratic component, meaning that a fund with a high picking ability will select funds with constituents with high future idiosyncratic returns and will underweight constituents with future low idiosyncratic returns. We see that for all significant results, the coefficient is negative, meaning that on average, AI funds have inferior stock picking ability compared to the rival funds. And the average return loss associated with that inferior stock picking amounts to 57 basis points, meaning that while AI funds have market timing ability, all the gains from the market timing ability are subsequently offset by inferior stock picking abilities. Some studies have already used in the introduction, such as Van der Berg, for instance, look at the flows of AI funds and of ESG funds and find that ESG funds attract investor attention and get higher inflows. These inflows create a price pressure onto those onto those funds, and due to the inelasticity of demand, it creates higher flow-induced returns. And we were interested whether AI or the label AI would have similar effects than the label ESG, because we suspected that ESG is a topic that investors look at, and AI might be a topic that investors might look at. Therefore, we thought that we would have similar effects. And given that our sample relies on funds using AI actively or claiming actively to be AI funds, we thought that the effects might be strong. In order to do that, we computed the fund flows and regressed them again onto our AI fund dummy. Nevertheless, we see no significant results. We then proceeded to add further control variables such as past performance and other control variables that were put forward in the literature. And we find that the coefficients for past rolling alphas, is high in magnitude and significant, meaning or suggesting that past performance seems to be the main driver of investor flows towards AI funds. Also, the coefficients for alpha remain significant if we switch from absolute fund flows to relative fund flows. Now, in order to most of our methodology relies on identifying those AI funds. And in order to assess the robustness of our results, we altered a lot the design of how we identified rival funds in order to benchmark the AI funds. For instance, we dropped the orthogonalization and changed the matching variables in our set of characteristics, of fund characteristics. Here we plot again the cumulative monthly returns. The black line, the solid lines represent the AI funds, and the dotted line represents the rival funds. And gray lines represent equal weighted aggregation, black lines represent value weighted aggregation. And we see that even though we dropped the orthogonalization and we dropped and we switched the matching variables, the cumulative monthly performances of the rival funds do not alter in a very substantial way. As to say, the findings are robust to the set of rival matching. We also proceeded and dropped the Z-scores and switched to percentile ranks. And again, if we look at the dot dash line, we see that there is no large influence regarding the performance of the rival funds based on whether we use Z-scores or percentile ranks. Also, if we remember the performance of the quantitative funds in the Sharpe ratio table, we saw that AI funds did not manage to outperform or to generate higher Sharpe ratios than with the quant funds, but also the differences were not significant, and also same as with the normal rival funds, meaning that it is also robust to the selecting quantitative funds as rival funds. Additionally, we've ran further robustness checks. For instance, we included the tiny funds, which we excluded from our analysis because we thought that those tiny funds are simply simply some fund shells that are not actively managed. We also investigated potential incubation bias. We find small evidence for an incubation bias. Nevertheless, the problem is the process requires us to cut away 3 years of data. And if you remember from the introduction, the IEQ was launched in October 2017, meaning if we cut away first 2 or 3 years, we start somewhere in Corona, and meaning in the COVID recession, and then we only have like 3 years left to evaluate our data set, which is already even lower than we have. Yeah. And as already mentioned, we use quantitative funds as alternative benchmarks as well. So in concluding, we evaluate funds that claim to use or to enhance their portfolio management using artificial intelligence. And we find that those funds do not outperform conventional funds that follow a similar fund objective just without AI. And additionally, they also do not outperform a set of quantitative funds, and also they do not outperform the markets. We further also do not find that this labeling of an AI fund attract further attention from investors. Overall, we also see that AI funds are less active than traditional funds and exhibit market timing ability. Nevertheless, all the gains from those market timing abilities are offset by inferior stock picking ability. Yeah, that's basically an introduction into my research. I appreciate your attention, and I very much look forward to your questions and feedback. I already saw there are 2 comments in the chat. And if my presentation sparked your interest and you want to know more, make sure to scan the QR code. It should take you directly to the SSRN page of the paper, where you can download it and read the paper again if you want to dive deeper. Thank you very much.
Mauricio. Thank you very much. Thank you. Questions from the audience? I had one quick question. Is it possible that, basically what you're showing is that these funds do not outperform by far, and that the funds flow is driven by past performance? Is it possible that some funds are using AI but do not declare themselves as AI funds?
I'm quite sure that there might be some funds that use AI but do not declare it. That's also one limitation that I mentioned at the beginning. The problem is we rely heavily on funds declaring it, that they are AI funds. And we saw some funds where we were semi-sure that they use AI, but if we were not 100% sure there is some AI involved in this fund, we did not include it in our set of AI funds. In that regard, I know that there are some funds that use some vague descriptions of what they do, and it's the same with Berkshire Hathaway, which tries to postpone as long as possible their fund holdings to prevent copy traders, for instance. And I assume that it's the same thing with with the description of the methodology, you try to be as vague as possible or as opaque as possible to prevent anyone from copying your strategy, for instance. And this was a limitation in our sample.
Okay. Thank you.
There
Marie?
is an ESMA report. So thanks a lot. It's a very interesting paper. And there is an ESMA report which is pointing similar results in Europe. So they're looking at European mutual funds. And from their discussion with mutual fund managers, they exactly point this, that a lot of fund managers don't want to disclose if they're using AI. It could be also a part of the process with human oversight. So for example, if a portfolio manager is using an AI signal, but there is human oversight, it would not necessarily be mentioned that it's AI ruled because it's only a small part of the process. So, but still, I think your analysis is very interesting because it allows to compare these funds that are advertised as AI driven with others. And I had a couple of questions about the fees. So I was not sure if these were net or gross return, and
those are returns after fees.
After fees, okay. And did you compare the fees as well? Because that's also a very important question for supervisors. Are these funds more expensive than others? That would be interesting.
I did a fee analysis, but I did not include it in the paper yet because the problem is, and this is also a problem mentioned in other papers such as Berg van Binsbergen and Gil Bazzo and Rui Verdus, that the CRISP dataset only has fees for about 40% of the funds. And first I have to find some way of parsing the other 60%. But I tried a preliminary analysis with the first 40% of the funds, and I found that the better performing AI funds have lower fees than the higher performing, which goes a bit into this direction of that better performing funds have investors with higher sensitivity towards past performance.
Yes.
And all the funds that charge high fees have retail investors probably that do not care much about performance or are not that sensitive in their demand.
Yes.
But again, those results are very preliminary and relies on 40% of data. Also, I need the fund fees to evaluate the skill of the funds following Berg van Binsbergen, which say you have to multiply it with the AUM of the fund because larger funds need to have higher skill than smaller funds. They have higher market impacts, therefore it's more difficult for them. And for that, you also need the fees to incorporate this. And I started, but again, with 40% difficult to say any.
I have, thanks a lot. I have a quick question before Sophia. Did you also look at the correlation between the performance of these AI funds? That's another big question from supervisors. Are these strategies correlated? You know, if they're using same type of signals, same types of models, maybe there is higher correlation between AI-driven funds than between traditional funds. Did you look at that?
No, I didn't look at this. I didn't look at the correlation. You mean within the AI funds, whether
exactly within the and in particular because you have these nice categories of AI fund depending on where they use AI in the investment process. So I would also be interested to see that within categories of AI fund, is it that they are having correlated signals and trade on the same type of strategies because they're using the same types of models? Honestly, I don't know, but I think that's something you could probably very quickly answer. So
I assume there could be some correlations because for some funds they are offered by the same investment company. So I assume that there is some they have the same insight, therefore they just use variations of it probably.
Yeah, but they could have different models as well. So
that could be true. Yeah.
Okay, thanks a lot.
That's a good point. Thank you.
Sophia, you had a question?
Yes, it's more on the research design. So I guess funds that declare that they use AI, it increases over time, no?
Yes.
So did you try to see before and after? So in terms of research design, if there is a change before they declare that they use AI on the process and after?
What you mean, whether the fund
So you collect this information from the description of the methodology, right? From this feeling, from the SEC feelings. And did you collect over time or just one point in time?
We collected over time, but if there was, say, a gap in the description, we assumed that it just changed the description of it, but it still remained an AI fund. So we assumed, okay, if we see that beyond 2017 it is an AI fund, it probably is also an AI fund towards the end of 2023. And if not, they are probably closed or discontinued.
Okay. But so you only collect one point in time this SEC feelings?
I collect them over several points in time, but if in one filing, one point in time, I see that they claim to be AI funds, I assume that they use AI in their portfolio creation process, but in the later stages, maybe they don't report it anymore because they want to be opaque about what they use in their portfolio creation.
Yeah, because what I was suggesting now is that to compare when there's a moment where they start to declare before and after to see if there is really a change on the performance, right?
Yeah, that would be an interesting point.
They could also change strategy,
Yeah, that's true.
That's another reason why they.
Maybe one quick question from the audience. There was a question on the chat. How do you weigh different characteristics when doing the distance calculation? Some of the criteria are more important than others when establishing the matches.
Basically, what this propensity, it's a version of propensity score matching, and basically, since we orthogonalize, the first variable is more important than the second variable and the third variable and so on. And then we say, okay, most important, same size and same age, same book to market and so on and so forth. Yeah, and then we vary which characteristic we use in order to prevent this weight. And if we drop the orthogonalization, each characteristic has the same weight technically, due to this methodology of computing the Euclidean distance.
Okay, well, thank you very much, Mauricio. Thank you very much, everyone, to Romeo and Mauricio for two very interesting papers. I would like to remind everyone that our next webinar will be somewhere at the end of April, beginning of May. We still haven't fixed a date yet, but we'll keep you informed. And just to remind you, we have two recent research letters that came out. One on harnessing large language model and asset management, and one on leveraging machine learning and mutual fund research. They're available on our website. You can download them if you're interested. Thanks everyone for showing up and attending this webinar. It's always very interesting to see academics presenting their research, which could be very valuable for us, the community in general, and asset managers. So I hope to see you next time. We'll keep you informed when the exact date is determined. And in the meantime, take good care and see you very soon. Thank you very much.
Thank you for the invitation and the comments.
Thank you, Mauricio. Thank you, Romeo.